years, residential prices in India have been going crazy.
2023 was a bumper year for Indian real estate.
Real estate market, which is exploding.
A dip in residential sales.
A single penthouse in
This is the new growth frontier of Indian real estate.
Every time these prices go up, a lot of people say that the bubble is about to burst. Because this time, things are serious. 28% dip in residential sales in the top 7 cities of India. More than 5 lakh houses unsold across these 7 cities. And almost 2,000 housing projects on hold across 42 cities. So the question is, are we standing at the edge of India's real estate correction, or is this just noise before another bull run? In this video, we'll uncover all the data, the history and the global comparisons with different countries to see whether buying a home in 2025 is a once-in-a-life opportunity or a mistake that would cost you lakhs. Let's deep dive, and before we start, this episode is powered by Grow, but more on that later. You open real estate portals, calculate EMIs, and the numbers make your head spin. One report says that home prices jumped 21% in top cities on an average in 2024. Another report says that the sales crashed 28% in the first half of 2025. So let's see what's actually happening. 2024 was a big year for price increases. We saw major jumps across metro cities. Kolkata prices went up by 29%, Bangalore by 15%, and even Pune, which used to be an affordable option, saw a 10% rise. But then 2025 started and something changed. Sales started falling. In the first quarter, sales dropped by 28% compared to the same time last year. We went from around 1,30,000 units sold to just 93,000. That's about 40,000 fewer homes that people bought. And this wasn't just a one-time thing. In the second quarter, sales dropped by another 20% compared to the same time last year. So now for 6 months straight, fewer and fewer people have been buying homes. Right now, the unsold stock of homes adds up to be about 14 months of supply across the country. So in simple terms, even if no new project is launched from today, it would still take more than a year to clear the supply that we already have. Hyderabad has the highest inventory with 26 months of unsold homes. So even if no new projects launch, it would still take more than 2 years to sell the homes that we already have in Hyderabad. Chennai and Kolkata aren't far behind with 21 months. In Mumbai and Delhi NCR, it's roughly 16 months each, while Bangalore has about 12 months and Pune also hovers around 14 months. So now with so much inventory stuck in the market, you would expect that developers would now build more affordable homes. But no, most new launches are luxury and premium and now account for 62% of the sales. So well, what does this all mean? To be honest, the signals are quite mixed up. So it can be helpful to look at what happened before in similar situations, because the real estate markets tend to repeat certain patterns even if the details are different. So now let's see what history can teach us about situations like this. And by the end of this video, you will know what type of buyer you are and what makes the most sense for you. We've seen similar situations like this in other countries, and looking at those might help us understand what could happen in India. Back in 2005 and 2006, housing prices in America started going crazy. They were growing 20% every year, which sounds a lot like what happened in India last year. People were buying homes they couldn't afford because everyone believed that the prices would keep climbing. But then in 2007, sales kept dropping, but the prices kept rising. Sounds familiar? That's exactly what we're looking at in India right now. Fewer people are buying, but sellers and developers keep pushing the prices higher. In 2008, home prices fell by 30 to 50% in some parts of the US. People who thought that property only ever goes up suddenly owed more on their homes than their houses were worth. But this crash didn't come out of nowhere. There were warning signs all along. Banks had been giving out really risky loans to people who couldn't really afford them, often without any real income checks. And the builders kept adding more and more supply because the credit was so easy. On top of that, investors were flipping houses just to make a quick profit, pushing prices way above their real value. So when the interest rates rose and borrowers started defaulting, the whole chain collapsed. Lenders, builders, and buyers all got hit at once. And this is why spotting early signs matters, because bubbles grow quietly over time, before they finally burst. That was 2008. Now let's talk about 2020. In 2020 and 2021, China had way too many homes being built. They had too much supply, just like we're seeing in India with double-digit month inventories. In 2021 and 22, sales started slowing down, but the developers kept pushing new projects. Again, sounds familiar, right? From 2002 until now, prices in affected Chinese cities have dropped 20 to 30%. So where does that leave us? Well, India's situation does have some striking similarities to both of these situations, but there are also some important differences. Similar to US and China, there is a disconnect between what can people afford and the prices of these homes. We have a premium segment oversupply. Sales are dropping, but launches continue. But here's why India might be different from these two crash scenarios. Our regulatory framework is much stronger now. Banks in India just can't give out unlimited loans. There are strict caps. If the house is under 30 lakhs, you can get up to 90% loan. Between 30 to 75 lakhs, it's 80%. Above that, only 75%. On top of this, RERA makes sure that your money sits in a safe account. So even if the developer has problems, your money isn't lost. And the National Housing Bank is watching closely so banks don't bend these rules. This doesn't mean there is zero risk, but it does stop a big crash like what happened in the US. Knight Frank India's senior executives recently said that prices in Mumbai and NCR have been absolutely not justifiable and predict prices will cool down slightly in the coming quarters. Even the industry insiders are saying that the correction has already started, particularly in the upper end segments where most of the oversupply sits. The more affordable segments might stay stable or see smaller corrections. If history is any guide, overpriced segments could see corrections in 12 to 18 months, especially in areas that spiked the most in 2024. But India's market is so unique, it might just play out very differently. What is clear though is that the mixed signals that we're seeing today don't usually last forever. Markets usually pick a direction, and history suggests that that direction is often a correction when prices get too far ahead of what people can actually afford.
And if real estate feels risky right now, smart investors often diversify into equity markets during uncertain real estate cycles.
And this is where Grow can help. Grow makes equity investing incredibly intuitive. The platform is designed to be beginner friendly with clean interfaces, easy to understand fund information, and step-by-step guidance. Even if you're completely new to mutual fund investing, you can research different equity funds, compare their performances, and start building your portfolio. Check out the description for more details. Okay, so now we've looked at all these numbers and what happened in other countries, but let's be honest, you probably are wondering what this means for your specific situation. Honestly, I wish I could give you a yes or no answer, but the truth is it really does depend on your situation. I know that's very frustrating to hear, but your timeline, goals, and income matter way more than any predictions in the market. Well, what I can do is break this down into 3 categories, and you can see which category do you fit in. Category 1, buy now. You might fall into this category if most of these conditions apply to you. You're planning to stay in the home for at least 7 years. You can put down 30 to 35% as down payment without wiping out your savings. EMI is 25% or less of your take-home salary, and you have a stable job. If you tick most of these boxes, buying now might actually make sense, just don't skip the negotiations. With sales dropping nearly 28%, developers might be open to discounts now more than ever. Category 2, wait. If you're in this category, you want to buy a house, but you are in a risky territory. Maybe you can afford to buy a house, but just barely. You are in this category if most of these conditions apply to you. You're looking at homes in the 1.5 to 2.5 crore range where new launches have spiked since these saw the biggest price jump in 2024 and are most likely to correct. EMI would cross 30% of your take-home salary. You can only put down less than 20% as down payment, and you are targeting areas where prices rose on hype and not on real demand. If this sounds like your situation, waiting 12 to 18 months actually makes much more sense. Save up for a bigger down payment and keep a lookout for the inventory in your target areas. Category 3, avoid buying. This mainly applies if you're planning on buying a house as an investment to rent out and not as a place to live in. Right now, rental yields in most cities are around 2 to 4%. Mumbai gives you barely a 2.5% rental yield. Even the best markets like Ahmedabad only give you 3.9%. So when your home loan costs 8.5%, you are guaranteed to lose money if you're looking to use your rent to cover your EMI. Let's look at an example. Say you buy a 2 crore apartment in Mumbai. Your down payment would be around 50 lakhs. You take a home loan of 1.5 crore at current rates of about 8.5%. That means your monthly EMI would be roughly around 1,28,000. Now, what could you realistically rent out this apartment for? In Mumbai, you're looking at 40 to 45,000 rupees a month, which barely gives you a rental yield of 2 to 2.5%. So every month you're collecting 45,000 in rent but paying out 1,28,000 as EMI. That's a monthly loss of 83,000 rupees straight out of your pocket. Even if you factor in the tax benefit on home loan interest, you're still losing 65 to 70,000 rupees per month. Over a year, that's nearly 8 lakh rupees you're paying to own an investment property that's bleeding money. And now that you've figured out which category you fit in, let's talk about some approaches that might work. If you are in the buy now category, you might have a 6-month window to act. But you also can't rush into a bad deal. From what I gather, tier 2 cities might be worth exploring. Tier 2 cities seem to be doing a lot better than the metros right now. In fact, the total value of homes sold in India's top 15 tier 2 cities went up by 6% in Q1 of 2025 compared to last year. Tier 2 cities are seeing 17.6% average capital appreciation in residential properties in comparison to metro cities. Take Goa for example. The prices there shot up by 64%. Coimbatore went up 47%. Lucknow saw a 24% growth and Indore climbed 23%. Even smaller cities like Jaipur and Kanpur posted solid gains of 21% and 20%. And then there are top emerging markets like Surat and Kochi. Both are showing high growth potential thanks to better infrastructure, lower living costs, and rising economic activity. Within these cities, stick to established areas with visible infrastructure rather than chasing upcoming area stories. Prefer ready-to-move-in or under-construction projects from developers with a solid track record and make sure they are RERA registered. Now, if you are in the wait category, you might be looking at a 12 to 18 month timeline. And here's what seems to work for most people. First, try to get your down payment to 40% or more. This gives you serious negotiation power if correction happens and also protects you in case the prices drop after you buy. Keep a close eye on the inventory levels in the areas that you want to buy. When the inventory starts climbing above 18 months, that's usually when the sellers get really desperate. You could also rent in the area where you eventually want to buy a house in. This way you can really get to understand the neighborhood, and in the meantime you can invest your EMI money into other asset classes. If you're really disciplined about this, you might end up with more money when it's time to buy a house. If you are in the avoid buying category, the safest move is to not buy an investment property right now. But if you still want real estate exposure, here's what might work better. Consider a REIT instead. A REIT or a real estate investment trust lets you invest in real estate without actually buying the property. You basically put money into a fund that owns offices, malls, or other commercial spaces, and you earn a share of the rental income. Right now, most REITs in India are giving a 6 to 8% annual return. Another option is equity mutual funds. Historically, these funds have beaten rental property returns. You are looking at 12 to 15% returns if you pick good funds and stay invested. For stability, you can also consider debt funds that are giving 7 to 8% returns with a much lower risk compared to other asset classes. Now let me show you how you will benefit with an example. Say you have 50 lakhs to invest. You take that amount and split it. 30 lakhs in equity funds, 15 lakhs in REITs, and 5 lakhs in debt funds. Your equity portion would earn 12% annually and would grow to approximately 93 lakhs. The REIT portion at 7% returns would grow from 15 lakhs to about 30 lakhs. And your debt fund portion would grow from 5 lakhs to about 10 lakhs. That's a total of 1.33 crores after 10 years. And if you're still convinced you want to buy property for investment, wait at least 2 to 3 years for things to stabilize. And when you do look, focus on markets with rental yields of 4% or higher. Look, we're all just trying to figure this out. Your family will keep pushing you. Agents will say buy now before the prices go up. But the thing is, your situation is different from anyone else's. What might work for your friend might not work for you. There is no single right answer. Many should buy now, many should wait, and many should rent out their houses and invest their money elsewhere. Figure out which category you fall into based on your income and goals, and then pick a strategy that feels right for you. If you found this breakdown helpful, hit subscribe, because on this channel we help you make smarter financial decisions.